Hey folks, good evening, good afternoon, good morning. Can you guys hear me loud and clear? Please let me know in the chat if you can hear me loud and clear, and after that we'll start in just 2 or 3 minutes. Thank you guys, thank you for letting me know. So I'm just waiting for a couple more people to join, and after that we'll start. So before I do start, I want to let you guys know that these lectures are going to be very advanced. So if you are just a beginner, it will be like very hard. It will be easy for you to understand. Okay, I made it easy for each one of you to understand. It doesn't matter if you're a beginner, you will understand the concept here, but when you go in your chart, it will be very hard for you to identify it because these things require experience to see it. And I'll help you to see it in live price action through my tape reading sessions on YouTube that I do for free. So yeah, if you are confused with this concept, you understand it here, but it's getting hard for you to find it out on chart, then come and see me trade in front of you live. I'm gonna do it every single day throughout the November session, throughout the whole month of November on my YouTube. And yeah, after that I'm gonna close the tape reading session on YouTube and I'll start tape reading only for the people who join my mentorship. Okay, first I'll share a couple of models that goes with Turtle Soup. First model is gonna be very high probability. I already shared one model that is like very easy to spot in chart in day 2. Do you guys remember I told you guys that this is A plus setup in Turtle Soup, and I took couple of trades. I identified couple of models live in my last couple of streams. Okay, so if you guys go on my YouTube and check out last 2-3 streams, you'll see me taking or calling markets by using the same model that I taught you guys in day 2 as a Turtle Soup entry. I'm gonna teach you guys couple more models today. I'll teach you guys how to take entry as a Turtle Soup in a Turtle Soup by using higher time frame pretty arrays on lower time frame. And trust me, you didn't saw anyone presenting this to you. Okay, the way I'm gonna present the Turtle Soup model, it doesn't exist anywhere else. Okay, so it's totally based on my experience, what I saw for last couple of years in chart. I'm gonna transfer my experience to you. It's not just a theory, it's what I saw in price repeating again and again and again. And when I teach you, when I show you these setups, you'll understand. You cannot fake experience. Okay, so we will start right now. I believe yeah, I only see 25 people. I thought like more people will join. Maybe they will watch the recordings later on. So let's start, folks. So for you to understand Turtle Soup, how to take entries with higher time frame PDRA by using higher time frame PDRA on lower time frame, you will first have to understand the anatomy of PDRA. What is this? High frequency algorithm will take measurement of a PDRA into consideration, and based on that it will deliver liquidity with precision. Okay, I drew a candle here. So suppose this is a fair value gap on daily chart, on 4-hour chart, anywhere on higher time frame. And what time frame we consider as higher time frame? 15-minute, hourly, 4-hour, daily, weekly. Okay, we are trading on 5, 3, 2, 1, and 30-second. Whatever I'm gonna show you here works on every other time frame, but I saw these patterns repeating more on lower time frame than higher time frame, more accurately on lower time frame inside 5, 3, 2, 1, 30-second. Okay, so suppose this is a fair value gap, suppose this is an order block, and we will measure the order block like this. Most of you already know the concept of anatomy, how we apply this. You already saw me using it in live price action many times before, and today I will introduce to you by using the same theory how to take a Turtle Soup entry. So for that, I'll take you guys through the basic first. When we see a higher time frame fair value gap, we measure it like this. This is the high of the fair value gap. This is the upper quadrant, 0.75%. This is the midway, 0.5%. This is the lower quadrant, 0.25%, and this is the low, 0. Okay, this is the, suppose this is a fair value gap, so this is gonna be the low of the fair value gap. If we take the measurement of a higher time frame PD area and apply it to lower time frame, we will find precision from where price will reject. Okay, so this is, suppose this is a higher time frame fair value gap, you don't basically know from where exactly price will reverse, right? From where exactly inside that fair value gap price will reverse, and this is what gives you the precision. Price will, I wrote it down here, best rejection will happen from bullish scenario. Okay, in a bullish scenario, so suppose this is a BC and you want to take a trade from this by using this higher time frame BC on lower time frame, so you will expect best reaction from the high, the upper quadrant, and the midway. If price is going below the midway, you are wrong probably. Okay, price will go even lower, and that's what happens most of the time. Your best reaction will happen from the high. I will teach you guys how to take trades by using the high, what condition price presents in front of you to take trades by using the high of a fair value gap, what condition price presents to take upper quadrant and midway. Okay, I'll share the profiles, the way market will present this structure in front of you. I'll show you guys the same repeating structure in a bearish scenario. So suppose this is a bearish fair value gap, or suppose this is a bearish order block, so we'll expect the rejection in price from the low of the bearish fair value gap or order block, from the lower quadrant and the midway. The best reaction happens most of the time at midway. This is the high probability, but I'll also show you guys when to take trades by using low, when to take trades by using the midway, right? There's always a question like, Hydro, how can I know the price will not reach at the midway? Price will reject from the low, right? How can price reject from the, how can I know the price will reject from the lower quadrant? And this is exactly what I'm going to share with you from my experience. So I hope you guys understood how we use it. This is a fair value gap from the higher time frame. We see it, we put our measurement here, and this is how we measure by high, upper quadrant, midway, lower quadrant, and low. So here's a note at the below. You can see we are only measuring candle's body. Okay, we are not gonna measure the wicks. Wicks do the damage, and it's a part of manipulation. That's where the stop hunt happens. Okay, that's where the turtle soup happens on lower time frame. But what I'm gonna show you guys is a little bit different than what you already saw other people teaching about turtle soup. So liquidity is inside the body, that's why we will mark the body, and from this level, from the body inside, okay, from inside the body, we'll have the best reaction. So now let's go to our next slide. And as you guys can see, we have our first model here, turtle soup plus anatomy of PDA. So how does it works, right? So we have our bearish higher time frame PDA here. So this is our higher time frame bearish PDA. So what do we do here? We have a couple of rules. I'll go through it. So at first we identify our bearish PDA. Now let's see what our rules tells us. The first rule is to identify higher time frame PDA for potential rejection or support. It's very easy to identify, right? It's very easy to identify a fair value gap on higher time frame. So you saw the fair value gap, suppose you saw it, and now how do you trade it? Apply anatomy of PDA. Okay, this is the anatomy of PDA, and this is what you apply on your chart, the measurement of the PDA. You measure the chart like this. The third rule is drop down to the lower time frame. Okay, you see the bearish PDA on higher time frame, then you drop down to the lower time frame, and this is the structure that you are looking for. Okay, it will repeat, it repeats every single day. And the fourth rule is find out on lower time frame all swing high or low. Okay, a swing high, if it's a bearish PDA, then you want to find a swing high. If it's a bullish PDA, you want to find a swing low near or below high, near, below, or inside higher time frame PDA. So here's what is high probability. If the swing high, this is a bearish example, okay? So we have our bearish PD area here. We applied our anatomy of PD area here, right? Our high probability is we have a swing high or swing high below the bearish PD area. The fifth rule is wait for a stop hunt. Okay, we are not taking entry as soon as price goes above the swing high. Okay, we are not doing that. We wait for price to hit the higher time frame PD area. We apply the anatomy of PD area right here and wait for our best rejection. What did I show you guys in our previous slide? That the best reaction from a bullish or bearish PD area happens from the 0.25, from the low, and then the 0.25, and then the midway, right? This is our lower quadrant and this is our upper quadrant. So you will take entry after price clears out the swing high from here and hits the low, and this is where you take the entry. Okay, you see where price is showing you the best entry, and this is what you learn from your experience. But if you don't have experience, you are building it, you are demo trading it, then put your entry here, okay, just at the higher time frame bearish PD area, and you wait for price to reject from the midway. You leave some room for price to go up. You put your stop loss above the higher time frame PD area, and the ideal TP in this scenario is 2 hours. So our sixth rule is wait for price to reject, get support from the high probability anatomy levels. So these are the anatomy levels, right? So in a bearish condition, the high probability anatomy levels are low of a fair value gap, the lower quadrant, and the midway. We wait to see from which level price will reject. Okay, and how will you know the price will reject from these levels? That's what I'm going to show you guys in the examples. And this is where you take your entry, and this is what is your turtle soup. Okay, so I hope you guys understood. Now let's talk a little bit more about this structure. As you guys can see, price has relative equal highs here. Okay, so this is high probability, all swing high with equal highs plus below higher time frame PD area. So what did I told you guys? The high probability condition is we have a swing high with relative equal highs below the higher time frame PD area. Okay, price can also have this swing high inside the higher time frame bearish PD area, but the high probability is price when price is a swing high with relative equal highs below the higher time frame bearish PD area. And as you guys can see, we have a lot of relative equal lows down here, and that's what you want to see when price is going for the stop hunt here, and when price is hitting this higher time frame bearish PD area. You want to see price constantly generating relative equal lows or trend line liquidity and not clearing it out. Okay, so suppose price is generating relative equal lows right here, and at the same time price is clearing it out, your trade is not as high probable as you think. You want to see price not clearing out these relative equal lows and trend line liquidity. So what it will do is that when price generates these relative equal highs, clean levels, it works for a magnet for price because these are retail stops. Okay, once price is done providing liquidity to a certain level, and which level? Above this swing high. Okay, what is this? Retail stops again, right? Retail buy stops, because these are relative equal highs. So once price goes above these levels, price is clearing out retail stop. At the same time, price is getting liquidity from our higher time frame bearish PD area. What is this PD area? This is a fair value gap. This can be an order block, this can be anything. Okay, but the best is when we have a fair value gap. And then this is where your turtle soup entry happens. Okay, I hope you guys understood the concept. The concept is you look at the rules. Okay folks, I really tried my best to put everything together here. So at first I'm gonna go through this again. At first, to identify higher time frame PD area, we don't have to know the bias. If the higher time frame PD area is bearish, okay, so suppose we have a CB, so we take entry from the CB, a bearish entry. We look for a bearish setup forming, and how will we know the price will reject from that higher time frame fair value gap? If you see this structure forming a lower time frame, that's when you will know that price will reject. When you see that price is leaving this relative equal lows on 3-minute, 2-minute, and 1-minute chart, or even 30-second chart, okay, this same structure will repeat on every single time frame. So suppose this is a weekly chart, you want to see price generating these levels on 4 hour, 1 hour. Okay, you can apply the same thing on hourly chart, but what I'm teaching you guys is not swing trading but scalping specifically on lower time frame. I'm saying you guys again and again, these entry models are high probability on lower time frame. These entry models works best on intraday sessions. So now let's go and look at our first example. So I did a recording of a I did made a recording of an example here. So at first I'll show you guys the example, and then I'll take you guys through what happened again. Okay, so watch it. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame PD array, and now I'm on hourly chart on Dow, and as you guys can see, we have a bearish fair value gap right here, and it goes with our bias, which is bearish. And how do I know my bias, right? We have a breaker here, higher high, new higher high. You guys can't hear? Really? Okay, let me check. Just give me a second. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame PD array, and now I'm on hourly chart on Dow, and as you guys can see, we have a bearish fair value gap right here, and it goes with our bias, which is bearish. And how do I know my bias, right? We have a breaker here, higher high, new higher high. So these down close candles becomes our breaker. Price closed the candle's body below the breaker, right? So price confirmed a advanced market structure shift. Price confirms its trend that it wanna go lower, and we have a fair value gap right here. Now we identified our higher time frame fair value gap. Now let's put the anatomy of fair value gap, anatomy of PD array right here. Okay, so this is our anatomy of PD array, and we applied it on our higher time frame PD array. Now as per our third rule, right, we will drop down to lower time frame and identify a swing high or a swing low. So here we are looking for a bearish trade, right? So we'll identify a swing high on lower time frame, and I teach you guys to trade on 3-minute, 2-minute, 1-minute, and 30-second chart. Now let's go to 3-minute chart. And as you guys can see, this is our higher time frame bearish PD array, this fair value gap. We applied our anatomy of PD array right here. Now we will identify a swing high. So what did I taught you guys about strong liquidity? A strong liquidity comes in two forms, right? Relative equal high, relative equal low, or trend line liquidity. And as you guys can see, we have relative equal high just with this higher time frame fair value gap, right? Price didn't traded inside this higher time frame fair value gap even on lower time frame. It left this relative equal high up here. So if you drop down to 1-minute or 30-second, you will see a swing high right here, but we don't need to. You already identified a strong liquidity level, so we will mark it. As for our third rule, we will wait for a stop hunt above here, right? We want to see price going above here and then rejecting from the high probability anatomy levels. What are these levels? 0.25, right? 0.5 and the low of this fair value gap. These are high probability levels. Lower quadrant and the midway. So now let's see if price comes towards buy side and shows a good rejection from here. And as you guys can see, price generated relative equal low, and that's what you want to see when price is that's what you want to see as your target. Okay, when you want to take a trade, you will have to have a strong target, and this will give you confidence in your trade that price generated it and when we see it, we know that these are levels that where price will come back again. So price left this relative equal low here, price generated another unfilled fair value gap, so a very strong confluence towards sell side. Now let's see if price rejects from here. Sorry for that. So price is getting support from this bullish order block, and as you guys can see, price hit the low of this fair value gap, and this is where is your turtle soup entry. Okay, your entry will be here, your stop loss will be above the higher time frame PT area, right? So this is our entry. Our stop loss is where, as I told you guys, our stop loss will be above the higher time frame PT area, and we will target 2R, right? And as you guys can see, 2R is like very near from here. So what I'm gonna do, I'm gonna target the swing low right here, and as we have a relative equal low right here, I will take a partial if I was in this trade. Now let's see if this trade is painting out or not. And as you guys can see, price didn't even went above the low of this higher time frame fair value gap. These levels, folks, are very sensitive for price. Okay, if price is going above 0.5% and closing a candle's body above, your short is not as strong as you were expecting, so you should not be taking that trade. But if price is staying below 0.25 and 0, the low of this fair value gap, this higher time frame fair value gap, you have a strong confluence that price will go lower. And we also identify the unfilled fair value gap, right? Unfilled fair value gap and relative equal lows attracts price like a magnet. And as you guys can see, price gravitated back to this relative equal low very fast, and ultimately it gave us our 4R. This trade was more like a 5R, so with this partial I'll consider it as like a 3R or 3.5R. So this was a beautiful trade, and our entry was here just at the low. Okay, so as I told you guys, our entry by using higher time frame PT area, by using anatomy of PT area, will be at the low when we are bearish. When we are bullish, our entry will be at the high, and we will expect a good price not closing a candle's body below the 0.5. There will be many more examples there I'll show you guys. Okay, so what did you guys saw here? There's another thing. Okay, I'll teach you guys candle counting. Okay, in our later lectures, a candle counting will be coming here. Okay, so when price rejects, price also leaves confirmation, like here. This is one swing high, this is another swing high, this is another swing high. So 3 dive pattern is also visible here, and this is what I'll teach you guys in our upcoming lectures. Okay, also there was another entry, right? This is what I taught you guys in breaker lecture, a very clean breaker. As soon as price cleared out the buy side liquidity from above these relative equal highs, right, price rejected, and this is where you take your turtle soup entry. But if suppose you miss the entry, miss the turtle soup entry, and you are not experienced enough, you also got a chance to enter with this breaker, and price came back to this breaker, right? Price generated a fair value gap when it closed the candle's body below the breaker, and that's what you want to see. I told you guys many times in our first lecture that when price is going below these down close candles, okay, you want to see a fair value gap forming here. This is one of the highest probability breaker entry. Okay, and as you guys can see, price left this fair value gap unfilled. What we expect to see a immediate reaction. Okay, when price generates a fair value gap like this, we want to see price coming back up at the next candle, hitting the breaker and then rejecting. But here what did you saw? Price left this fair value gap, right? Look at these lows right here. Price left these relative equal lows and then came back up and then showed a very good reaction. So this is a nice turtle soup entry that I showed you guys. I'll show you guys another example, but before I take you there, Let's look here what I wrote. When price goes above strong liquidity, equal high, equal low, we can also consider it as a high probability reversal zone. So where was our relative equal high? Right here, right? And it gives us a high probability turtle soup entry when price goes above these retail stops. Okay, basically retail are not selling on lower time frame here, but this is how algorithm sees it. And price went above, good rejection, that's why you enter. And you are not entering randomly. I'm teaching you from the higher time frame. We identify a higher time frame PDRA, we apply the anatomy levels. Okay, we see how price is closing each candle's body. So suppose you didn't got a chance to enter here, at the next candle you guys saw the price came back up, retested the low of this fair value gap, right? And exactly this is where price stopped. After I close my session, after I'm done with my lecture, go on your chart. It doesn't matter, whatever pair, gold, crypto, whatever, apply the same theory and you will see turtle soup repeating in front of you again and again every day. You just didn't know, but now you know it. Now let's go to our second example, and I will show you guys how to know that price will reject from the low. Price will not go above 0.5 level at the second example. Hey folks, so this is example number. Hey folks, so this is example number 1, and as you guys can see, as per our first rule, we will have to identify a higher time frame PDRA, and now I'm on hourly. Okay, so I played the example 1 again. Let's go to example 2, and this is the example 2. Okay, I'm gonna play it now. So here's our example number 2, and as you guys can see, we have relative equal low right here in a form of strong sell side liquidity. Plus we already know that we are in a bearish trend from this delivery right here. We have two big down close candle on hourly chart right here. So here's a gem that I'm gonna share with you guys. When we have two fair value gaps like this in a single price leg and the delivery is aggressive, how do you know which one to use, right? For that to know, you will have to look at this part of price, and as you can see, we have a fair value gap right here, which is very high probability. Why? Because this fair value gap is making this fair value gap a high probability fair value gap, because this is a balanced price range, a BPR. Okay, so now we will apply our second rule in this concept, in this trade idea, that we will apply our anatomy of PDRA. Okay, so in our first example, I showed you guys a PDRA on higher time frame which was smaller than this one, right? So when we have, so this is a gem, write it down. When we have a small fair value gap or small PDRA in higher time frame, we can put our stop loss above that PDRA. But when we have a big fair value gap like this, best is to wait for price to come to 0.5% and then show rejection. Okay, so when we have a small fair value gap or a small PDRA on higher time frame and we apply our anatomy of PDRA, we will expect to see a good reaction from the lower quadrant. Okay, but when we have a big fair value gap or a big PDRA like this, we will expect to see price coming all the way up into the 0.5% and 0.75%, and our stop loss will be above or at 1. Okay, but that's not it. We are not gonna put our stop loss just because based on this theory. We will also go through other time frames to see if our stop loss is valid or not. Okay, so we already identified the strong sell side liquidity. We know the trend is bearish. We applied the anatomy of PDRA. Now let's go to lower time frames and build our confluence. Okay, so as you guys can see, this PPR, okay, I'm putting it here, and this PPR on lower time frame will give us more confluence when price is trading inside it. On 50-minute chart, we can also see another fair value gap right here. So what did I told you guys? When price has a big fair value gap or a big PDRA on higher time frame, okay, in our first example, the PDRA was smaller. So when the PDRA is smaller, we put our stop loss above the higher time frame PDRA. But when we have a big PDRA on higher time frame like this, How do we trade it? We wait for price to come at 0.5 and 0.75%, okay, and we put our stop loss at 1. And how will you know that from which level price will reject? For that, we will have to drop down to 3-minute chart, and we'll have to find out a swing high inside this hourly fair value gap, right? So we have the measurement of our hourly fair value gap. We also have a 15-minute CB here, so let's mark it. So this is our CB from the 50-minute chart. This is the BPR from the hourly chart, and both of these are a bearish PDA. Okay, we are expecting a bearish price action. And now what does our rule say? To find a swing high on lower time frame. Okay, do you guys see that we have a swing high right here? So I'm gonna mark it, and now as I told you guys that when we have a big PDA on higher time frame, we wait for a rejection from 0.5 and 0.75. We don't do anything until price reaches here. Okay, now let's see if price is building strong sell side liquidity for us when it's moving towards these liquidity levels. And as you guys can see, price is constantly generating trendline liquidity, and that's what gives us confidence, that's what gives us confirmation that price will go lower from these levels. Okay, and as you guys can see, price showed a good reaction from the low of this fair value gap, but we are not executing here. Why? Because this PDA is big on higher time frame. Okay, so the rules are like this, folks. Okay, you will have to follow these rules. Sometimes you will see that price is rejecting from the low of the PDA, so you will have to also align other confirmation with chart, but the high probability is price rejecting from the 0.5 and 0.75%. And as you guys can see, price hit the 0.5%, but we already know where is our buy side liquidity, right? Our buy side liquidity is resting above this swing high, so we'll wait for price to go above this swing high and then execute. And as you guys can see, price hit the 50-minute fair value gap, right? And also price cleared out the swing high from the lower time frame, so this is gonna be our execution right here with a stop loss above or at the at the 1 level right here, about the high of the quadrant level. And what can we target? We can target the higher time frame relative equal lows that I showed you guys on hourly chart right here. Ideal target is 2R, but if you can control your emotions, okay, if you are getting experience, you can target these lows all the way down here. And as you guys can see, it's giving you a very small stop loss, right, and a very huge profits. But the high probability way to manage the stop loss is to put your stop loss above this fair value gap. Okay, when we have fair value gaps like this on lower time frame and price is trading inside it, and you are expecting a rejection or resistance from this fair value gap, I will suggest you guys to put the stop loss above the fair value gap. Okay, this is the high probability stop loss management. Now let's see if price trades in our favor. And as you guys can see, price gave you multiple chance to enter here, and when price went down, okay, went below the 0.75%, it also retested the level again before going down. And as you guys can see, price ultimately hit our TP at this level. So I hope you guys understood what I was presenting here, right? We are following all of our rules, folks. When we have a big PDA on higher time frame, we wait for price to reject from where? 0.5 midway in the upper quadrant. When we have a smaller PDA on higher time frame, we expect a rejection from where? The lower the low and the lower quadrant and the midway of the fair value gap. I'm repeating myself again. When we have a big fair value gap or a big PDA, and it's very easy to know, you see it on your chart on your higher time frame. If it's big, your eye is telling it. If it's big, you wait for price to show a rejection from the 0.5 and 0.75%, okay. And our lower time frame swing high also confirmed it. As you guys can see, we had a swing high here, and all we are doing is following our rules, folks. I'm giving you a footpath, I'm giving you a blueprint, and price is exactly printing these candles like this. When price is going up, okay, for these levels, you want to see price constantly generating these relative equal lows and not clearing it out. We have a higher time frame relative equal low here, but we are trading a lower time frame, so we want to see price not clearing out these relative equal lows, but we want to see price generating it and leaving it, okay. This is where the retails will buy, and once price is done delivering liquidity all the way up here, once price went above this swing high, as per our rule, this is our second rule, and this is the most important rule, is that you have to identify a swing high near or inside, okay, or below the higher time frame PDA. What is the high probability? We have a swing high below the higher time frame PDA. This swing high can also be inside the higher time frame PDA, but the high probability is when price has a swing high below the higher time frame PDA, and that's what I showed you guys in the example 1. And in example 2, I showed you guys that when we have a swing high inside the higher time frame PDA, that's how we trade it. And every single time, folks, it's a bet, it's a guarantee. When we have a big fair value gap on higher time frame, this is how price will react. Every single time you will find a swing high above the midway and below the 0.75 or at the 0.75%, okay. And suppose we have a fair value gap like this at the 0.75%, you are not putting your stop loss at 1, but you are managing your stop loss accordingly with the price delivery on lower time frame, which is above this lower time frame fair value gap right here. So what is the gem here? When we have a small PDA on higher time frame, we can put our stop loss above or below it. Above is when we are taking a bearish trade. Below is when we are taking a bullish trade. When we have a big PDA on higher time frame, we wait for price to show rejection from 0.5. This is the 0.5 level, 0.75, 0.75 level, and 0.25%. So 0.75 is when we are bearish, 0.25 is when we are bullish, okay. So suppose this was a bullish PDA, then we will expect to see price trading all the way down here 0.5% and not going below 0.25%. What do you guys see? Price came all the way up, retested the 0.75%, and then showed a good rejection, and this is your turtle soup model. And how do you get the confirmation, okay? How do you get the confidence that price will reject from here? Price will reject because you are looking at these levels, okay. Price is constantly generating targets for us. This trend line, liquidity, relative equal high and low are targets for us. In this scenario, we will put our stop loss above the high, bearish, okay. When we are bearish, this is the high, but we also put our stop loss aligned with the lower time frame candles. And as you can see on lower time frame, we have this bearish fair value gap, so we put our stop loss above this bearish fair value gap, because what sometimes price does is, we are trading on lower time frame, price becomes volatile, price fills the fair value gap and then goes down. So it's high probability to put your stop loss above the fair value gap on lower time frame, above or below, okay. So I hope you guys understood how to take an entry with turtle. So now I'm gonna look at the chat. These type of entries are inside macros always. Look, when price gave you this entry 12:20 to 12:40, I'm not talking about the time here, because I already talked about the time in day 1 and day 2 lecture. You already know we are taking our trades inside macro. Without macro, we are not taking any types of trades, and your high probability entries will form inside macros, folks, okay. If higher time, if hourly close above 0.5, 50% high fair value gap, is this cancel short trade? No, it doesn't cancel short trade. Go back and listen again. I told you that when we have a big fair value gap, a big PDA, okay, we wait for a rejection from the 0.5% and the 0.575%. But when we have a short PDA and price is trading back inside 0.5%, it's okay, because we are putting our stop loss above the 1 level, right? And that's what I showed you guys here. at this example, let me take you back here again. See, price rejected from the low of this fair value gap, but we are putting our stop loss where? Above the one level. So even if price is retesting this 0.5, we are not getting scared. Price will still reject, but the high probability is when price has a small PDA on higher time frame, we put our stop loss above the high, and the best reaction will happen from the low. I hope you guys understood. Now let's go to our next chapter. Our next chapter is rejection block plus turtle soup. I'll show you guys profile 1. We have 2 profiles using this theory. The next profile that we will have, I'll show you guys the next profile inside our mentorship. So this is what you will get here in the 3-day bootcamp, the profile 1. So now let's start. So what is a rejection block? When price has long wick or wicks at the top or bottom of price action, we refer to it as a rejection block. Okay, so these are rejection block because these are long wicks and price is getting support from these levels. Okay, so now the question will be, how do I trade it, Hydra? Because you are teaching us that these are targets, right? We are targeting it, but if we are taking entries using it, aren't we retail? No, I'm gonna teach you a different theory, and this will be different from any other theory that you guys saw in the whole ICT industry. So let's see. But here we will use it a little differently because rejection block is also strong liquidity and it comes in a form of relative equal high or relative equal low. Okay, I teach you guys that these are targets. We are taking trades targeting these levels, but we can also take trades by using these relative equal lows. So how to trust it? This is the main question, how to trust it, because price can also go below and then go higher, right? Because these are retail stops, so price can hunt for it. How do you know it? Now let's see it. So first, the first rule is price will have to do a stop hunt already. Okay, when price does a stop hunt and then uses these rejection blocks to get supports, this is the high probability condition. So stop hunt, high probability, not always required. Okay, this stop hunt is not always required, which I'll show you guys in the example 2. But in example 1, I'm showing you guys that when price has price already did a stop hunt and then getting support from these long wicks, this is a high probability condition. Thus our second rule is we will wait for price to generate 2 long wicks which are relatively equal. As you guys can see, 2 long wicks price generated. Why am I not considering this one, right? Because this is not a long wick. It's a basic thing. When you see this long wick, when you see 2 long wicks, that's when you trust it. When price comes back to the same level and rejects 3rd time, that's our turtle soup entry. Do you guys see it? So we have first wick right here after the stop hunt, right? And then we have our second wick right here. Now at this 3rd level we will take our entry, but how to trust it? We need more confirmation. The third rule is when price does come back to these wicks for the 3rd time, we want to see price closing a candle's body below the 2nd candle wick. So this is the rule. We identified our first big wick, right? This is a bullish wick, and then price came all the way down again, retested this support, and at the 3rd time when price does comes all the way down, we want to see price closing a candle's body below or inside this 2nd wick. Okay, price can also go a little bit down and get support from the 1st wick, but you want to see price coming down and retesting the 2nd wick. I'm telling you guys, this is advanced theory. It will take a long time for you to see in chart, and that's what I'll show you guys in mentorship. Okay, in mentorship I'll take you guys in the live price section. I'll show you guys that how it works. But now as per theory, I'll show you guys a couple of examples how it works. Now let's revise our rules again. First, price will have to do a stop hunt, right? This is our first rule, but this is not always required. When price does a stop hunt, this is high probability. Our second rule is we will wait for price to generate 2 long wicks. We identified 2 long wicks. Our first wick is here, our second wick is here, which is getting support from this first wick. And when price comes back to the same level and rejects 3rd time, which level? This is the level at the second week. We are looking at the second week. If price is coming back down and closing a candlestick body, isn't it getting easier? Yes, we identify 2 long wicks after price does a stop hunt, and we wait for price to close the candlestick body third time inside this candle wick. So our third rule is when price does come back to these wicks for third time, we want to see price closing a candlestick body below the second wick, and this is where price gives you a turtle soup entry. You wait for price to close a candlestick body below the second wick, and as soon as you see it, you enter the second you enter at this candle with your buy. Look for SMT right here, okay, because most of the time what I saw, that price is generating SMT below these lows and then going up. So this is what also works as a confirmation. So suppose I'm trading on US 30 and I'm looking at this formation. I'll also look at ES because these are correlative pairs, also NQ, and I'll watch that if price is generating SMT here. So I'm trading on US 30. I'm seeing this formation happening. I'll watch and see if on other pairs price is making a lower low here. So now let's see how can we take an entry here, our stop loss management and all that good stuff. So this is our chart that I showed you guys in the first in the previous slide. So price did a stop hunt, price generated a long wick right here. This is a swing, okay. Why am I not considering this one? So this is a good question, why I am not considering this one, because this is not a swing high, sorry, swing low, because when price generates a swing low, it will have to have 2 candles next to it above it, okay. This is a high probability swing low. Price generated it, we identify 2 long wicks, and we have our first wick. Our second wick is retesting this first wick, and at the third time when price comes back down and closes the candlestick body inside the second wick, this is where we get a turtle soup entry. When price closes candlestick body below the second long wick, this is our turtle soup entry. Our stop loss will be below the first wick, okay. Our stop loss will be below here. If price is going below this wick, we are probably wrong. Price is doing a stop hunt. Our target, it will be the swing high all the way up here. Ideal target is 2R. Look for all swing high or low. This is a all swing high or low, or relative equal high. This is also a relative equal high, right? This swing high is also relatively equal with this wick. Then we will also identify if we have a trend line liquidity. We don't here, but usually price does. We will also target, if we don't have any of these 3 things, we will also target the third one, which is an unfilled fair value gap. So it's very easy to understand. When price does a stop hunt, you wait for price to generate a high probability swing. Once price does that, you wait for price to come back inside this wick second time, and if price is repeating and coming back down inside this second wick again, you want to see price closing a candlestick body inside the second wick, and that's where you have a turtle soup entry. So now let's look at our example number 2. Rules. We will wait for price to generate 2 long wicks which are relatively equal, and when price comes back to the same levels and rejects third time, that's our turtle soup entry. Read it again, you will understand it clearly. So this is our first wick, right? This is our first wick. This is a swing high, sorry, swing low. Why? We have 2 candles right next to this candle which are higher than this one, right? The candle's body is not going below this candle here. So this wick got generated when price retested the first wick. Okay, now is it getting clear? When we have a wick, right, when we have our first wick, we want to see the second long wick retesting the first wick. We are not doing anything here, so we identified our levels. Our second rule is when price comes down, when price does come back to the wicks for the third time, we want to see price closing a candle's body below the second candle wick. So we want to see price coming down here and closing a candle's body here, okay. And as you guys can see, price came down, closed the candle's body here, and that's where you enter. If you want to get a little bit more confirmation, you can apply the anatomy of PDA that I taught you guys, right? So the best reaction will happen from the 0.5 and 0.25%. but it's not necessary. As soon as price comes down and closes the candle's body, which price did here, at the next candle you enter, and that's where is your turtle soup entry. So how does it happen? Stop loss, your entry is here, right? You are putting your stop loss. So look here, we have a big wick. So when we have a big wick and price is not going all the way down, in our last example, right, do you guys remember? Let me take you guys back. In our last example, as you guys can see, price came all the way down, filled the second wick, and then showed a good reaction. Okay, but in our next example, price didn't do that. Price rejected from the halfway, didn't even get to the halfway, but the upper quadrant, and then showed a very good reaction, support towards buy side liquidity. So how will you know the price will not go lower? That's why you wait for this candle to close. Okay, wait for this candle to close inside the second big wick. And here, as you guys can see, we don't have a stop hunt. When we have a stop hunt, that's the high probability condition, but when we don't have a stop hunt, it's okay. This also works when we don't have a stop hunt. Look for SMT with other correlative pairs right here below the swing lows. If we have a SMT right here, this will also work as an extra confirmation for you. So this is our entry right here. As soon as price comes all the way down, touches this, closes the candle's body below, we executed the second candle right here, and our stop loss will be, you can manage your stop loss accordingly here. Okay, what I will do in this situation is put my stop loss below the lower quadrant right here, but you can also put your stop loss below here, and target is our ideal target is 2R. That's what we will do. So do you guys understand this concept? This is basically a pretty hard concept to see on chart, because this repeats basically on lower time frame. This is what I saw when I was trading in 30-second, and mostly it repeats on 30-second, 1 minute. So yeah, if I see it in my streaming, I'll let you guys know, and you will see this pattern, me taking entries by using this pattern. The concept is very easy to understand. Okay folks, I can teach you here, and I told you guys when I started my stream, I will show you guys. I made it as simple as possible, but it's very hard to spot as a beginner in charts. So I already gave you guys 2 other models, right? Breaker, inversion, and those models are very easy to spot even when you are a beginner, right? So stick with that. Once you have pretty much confidence with other 2 setups, and you are confident to take trades, you are consistently taking trades with other 2 setups, look at these advanced setups. Okay, these are not for beginners. Turtle soup, trust me, is not for beginner. So this is another model that I'm gonna share. So before I do, let's see if you guys have any questions. Robert is saying, so if it does not close but wicks, do you take it or on the third time? Okay, so the rules are very clear, folks. We wait for price to close the candle's body below here. If we are not spotting it, okay, if it's not clear on chart, don't take it, because these are high risk trades. These requires long experience. I started seeing this pattern repeating from the last year, and slowly I built in my confirmation that okay, this pattern repeats and it actually works this year. Okay, so after like 3-4 years, I saw this pattern repeating on chart, and I was able to take trades by using these patterns after a couple of years. So it requires experience. As a beginner, you won't see it, but in hindsight, you will be able to spot it on chart. Okay, so the rules are very easy. You spot the first week, the second week is retesting the first week, right? You don't do anything. You are looking at chart. Then as soon as price comes back down inside the second week and closes the candle's body below here, you are not doing anything. You are entering at this bullish candle once you see that price is moving from the second candle towards buy side liquidity. Now, is it clear? What time frame macro you normally trading though, as you have many? I already answered it in day 1 and day 2. Go through these lectures and you will hear me mentioning it. Okay, relative equal high and low plus turtle soup. So in our day 2 lecture, I showed you guys a consolidation model. Okay, when price is consolidating, or ranging, right? We wait for price to clear out one side and then target the opposite direction. The same theory is here, but this time price is not consolidating, rather price is trending, but price generated relative equal highs up here. And this goes with our first model that I showed you guys, right? Which was by using anatomy of PDR. So the same thing is repeating here, but this time we don't have a higher time frame PDR. We are specifically looking on a lower time frame and seeing this pattern repeating. So let's see what I wrote here. When price generates buy side liquidity in a form of relative equal high low, it works as a magnet for price as it's a retail stop. By now you guys already know it because I have been repeating, I've literally been preaching this since the day one, and even before, if you guys were watching me, this is where I personalize. When price hunts these strong buy side buy or sell stop, it provides us a turtle soup entry opportunity. What is the opportunity? As soon as price goes above these relative equal highs, you can take an entry here, and that's what I'll show you guys in the examples. And it's very easy to spot. Okay, this is like one of the easiest spotty pattern on chart. Okay, I'll come back. I have a delivery here, so I'll come back in 1 minute. Okay, I'm back. Someone was ringing my doorbell. Yeah, it was Amazon delivery, so I'm back again. So these are one of the easy to spot chart patterns. The first pattern that I showed you guys using anatomy of PDA, and even before in the day 2 I showed you guys another turtle soup pattern, and these are similar patterns, but price presents these patterns differently. Okay, I'm showing you every single high probability pattern that repeats on lower time frame, and that's it. Other than this, price just consolidates, and we already know when price consolidates how to trade it, right? So here, when price generates buy side liquidity in a form of relative equal high or low, it works as a magnet for price or retail stops. The same thing, I basically wrote it mistakenly, so let me clear it out. Yeah, now it's looking good. So this is what's happening. Now let's look at our example. So here's our example with the rules and the complete entry model, right? This is our example number 1. As you guys can see, I gave you guys a complete blueprint of how price will repeat this pattern and how you will trade it, as we don't have a higher time frame PDA right up here, because sometimes you will see that there's no higher time frame PDA. Like there will be wicks covering the fair value gap, so there won't be a fair value gap, there won't be a breaker block, there won't be order block. Price is just having random candles on higher time frame, but on lower time frame you are spotting this pattern. Then how will you trade it? And this is how you will trade it. So let's read it. This is one of the highest probability turtle soup scenario. Every single day you will see this pattern repeating on all asset class. Trade management, how do you trade it? So we spotted our relative equal high, right? So before we do that, we want to see price generating relative equal lows or trend line liquidity in sell side. Okay, we are not just taking entries blindly when price goes above here. We want to see price constantly generating relative equal lows and trend line liquidity near sell side liquidity. If you have a clean swing low and you are spotting this setup, I'll highly recommend you not to take it. These setups are only high probability when price has more trend line liquidity in the opposite direction of your trade. Okay, so we are taking a bearish trade, so we want to see price forming relative equal lows, trend line liquidity, unfilled fair value gaps right here like this. So how do we trade it? At the double bottom top, you take the entry right here. Stop loss management, there will be most of the time a higher time frame PDA above relative equal highs or below relative equal lows. Okay, most of the time you will see that there is a higher time frame PD area. So on what time frame you will look for this PD area? So suppose this pattern is repeating on 1 minute or 30-second chart, that's why it will mostly repeat in an intraday session. So you will use 3-minute, 5-minute chart as a higher time frame, or 15-minute, and you will put your stop loss above that higher time frame PD area. You will apply the anatomy of PD area I showed you guys in the first slide. Okay, that's what you will do if you have a higher time frame PD area right here. If you don't have a higher time frame PD area, this is what you will follow. Best to manage stop loss accordingly with higher time frame PD area. But if you don't have it, your stop loss will be 20 to 25 points. That's the best when you are trading in features or indices. I believe like 20 points is a little bit like small, so 25 points is good. If you are like generous enough, if you are patient enough, then 30 points is the best, and don't go above it, because most of the time on lower time frame price provides 2R. Basically price reverses after providing liquidity till like 4R. So as you guys can see here, I wrote it here, ideal target is 2R. So price went up, cleared out the buy side liquidity from here, from these relative equal highs, and then rejected, and this is where you take your entries. If you spot a higher time frame PD area, you apply the anatomy of PD area. But if you don't have a higher time frame PD area, you put your stop loss above 25 points and you target the swing low right here. And as you guys can see, when price was going up, right, hitting the relative equal high, it also generated these relative equal lows right here. Do you guys see it? And it also, price also had a lot of relative equal lows right here, and that's what you wanna see price generating when price is moving towards these liquidity levels. But if you have clean levels like this, you can hold your trade from these levels. And these kind of trades mostly, okay, most of the time I saw that it provides more than 2R. So the ideal target, I already talked about it in our previous slide, and even in our previous days, that ideal target is 2R. But if there's no strong target, suppose you cannot see a relative equal high or relative equal low, which is like very rare, you will always find relative equal high or low with these models, okay, then you will target like unfilled fair value gap. There will be unfilled fair value gap, and if you cannot see any of these relative equal high, relative equal low, trend line liquidity, or unfilled fair value gap, I will highly recommend you guys not to take the trade, because there will be many opportunities intraday again and again inside our macros. Okay, so now let's go and see what our second example looks like. And in our first example, we took our profit all the way down here, right? So now in our second example, I'll show you guys how to take profits in the discount price lag. So what do you guys see here? I'll give you guys a couple of minutes to see, 1 minute to see this chart, and then I'll start talking. Isn't it easy to spot the relative equal low, relative equal high? Yes, so this is a very high probability pattern that I see in chart repeating again and again. So now let's put our lipsticks. We have our relative equal low down here, right? We expect to see price coming down and clearing the relative equal low, but before price does that, we want to see price generating relative equal highs, right? Because that's what gives us confidence in our trade. We want to see price generating strong target before giving us an entry. And what do you guys see? Price generated relative equal highs here, right? Price also has a unfilled fair value gap all the way up here. So these are like high probability targets, and we do have both of these in the single trade. Price came all the way up, generated another relative equal high, then rejected, cleared out the relative equal low, and that's where you enter. These turtle soup entries, folks, always is gonna be aggressive. That's why I'm telling you guys, if you guys don't have experience like couple of years behind you, skip this part, okay? You will not miss anything. There are many setups with breaker, and stick with it. Come back to it when you are feeling confident and watch these slides again. It will make more and more sense to you. So how do you take it? This is where you take your entry. Price will give you enough chance to take your entry here. Look at this candle. This candle opened here, right? It traded back down, and that's where it's giving you basically again and again opportunity to take a trade. So if you can spot a higher time frame discount PDRA right here, you will put your stop loss below the higher time frame PDRA. But if you cannot spot the higher time frame PDRA, then your ideal stop loss will be 25 points. Okay, 20 to 25 points. It depends on what you are watching near here. Okay, you will see that if you have a fair value gap, the price is filling. So suppose we have a fair value gap right here on lower time frame, and price filled this, so you'll put your stop loss below that PDRA, below that fair value gap. But if you suppose if you are very new and you don't have many experience behind you, but you are seeing this pattern repeating, then only then you will use 20 to 25 points. And if you are not confident enough, then the max you can go is 30 points. Above that, it don't work because the risk to reward ratio will be like very low. So I'll recommend you guys not to take it if your trade is suggesting you to put stop loss more than 30 points. So as you guys can see, price had relative equal high here, price left it, didn't clear it, came all the way down, hunted the retail stop. That's where we take our entry. This is our target. So if I was taking this trade, okay, I will take a partial here, and my initial target will be this premium PDRA. So do you guys see another profile repeating here? Yes, in day 2, okay, at the end I showed you guys 2 inversion models, and one inversion profile is repeating here. We have a fair value gap, right? So this fair value gap failed when this candle closed here, and when this candle opened, that's what I taught you guys inside our day 2 lecture, that this is an immediate rebalance from this inversion. So price is giving you a chance to pyramid. That's why I'm telling you guys to stick with day 1 and day 2 model if you are a beginner. For you, if as a beginner, to take entries like this will be very hard, but at the same time, look here, price is giving you another opportunity to take entry right from this inversion, and it's very easy to spot. When you are taking trades with turtle soup, your heart will shake as a beginner, but when you are looking at these models like breaker, it's very easy to spot. Inversion is very easy to spot. Inversion is what? A failed fair value gap. How do we trade it? When price goes above that inversion, closes the candle's body, we wait for the next candle to come inside the inversion, do the immediate rebalance, and then go higher. The same thing repeated here. Price closed the candle's body at the inversion, right? And then this candle, when it opened, it traded lower, and that's what you want to see. You buy in a bearish candle, and when it traded lower, you buy here. The next candle, it also gave you guys another chance of entry. Okay, how do you manage your stop loss here? That's what I taught you guys in the day 2. You will put your stop loss below the inversion, and you will target 2R from here. So this is the whole model with relative equal high and low, which is similar to our first model, right? And even with our day 2 model, day 2 turtle soup model is basically a consolidation. Here what I'm showing you guys, that price is trending, but it also giving us opportunity to take turtle soup entries. So do you guys understand the concept here? Let me know in the chat, and then we will move towards our next lecture, which is a 3-dive pattern. Okay, the 3-dive pattern, folks, it works like a charm. Mostly on crypto you will find it repeating, but even on indices it's the best. Okay, 3-dive pattern is the best confirmation to predict a reversal. So is it clear, folks? Okay, so now let's go to our 3-dive pattern, and this is basically like a retail concept. Okay, when I was trading with retail concept, I learned this, and even after I found ICT, I saw him using this 3-dive pattern, and I'm gonna share with you guys how I traded this pattern. Works best in crypto. It also do work on indices and features chart, on stocks charts. Okay, if you, after I'm finishing the lecture here, go on your chart and you'll see it repeating again and again. I'll show you guys a couple of examples to make it clear. even when I showed you guys the first example, okay, with the first model in this slide, there was 3 dive pattern repeating. So once I'm done with the lecture, I'll take you guys back into those reviews, and I'll show you guys how that pattern repeated. So what is a 3 dive pattern? A 3 drive is a common price pattern formed by 3 consecutive symmetrical moves. These are the symmetrical moves. Price is constantly generating what? Relative equal lows, trend line liquidity. In its bullish form, the market is making 3 final drives to a bottom before an uptrend forms. In a bearish 3 drive, it is peaking before the bears should take over. Okay, so what is happening is that price is constantly generating relative equal high and lows. And how will you know the price will reverse? So what I taught you guys already, that we will wait for price to hit the higher time frame period, right? So we already know how to apply ICT concept, but we'll also learn how to see market with retail concept that works. So we have our first swing here. I'll show you guys the logic in a simple way. We have our first swing here, we have our second swing here, we have our third swing here, and once price clears out this third swing at the fourth, we expect a reversal, and that's where price gives us a turtle soup entry, and we will target the third swing and the second swing. This is the high probability, because at the first swing, okay, here we will have suppose a fair value gap with the order blocks. So this is a deep discount level from where price will reverse. Our ideal target will be third swing low, second swing low. Okay, it's very easy to understand. I'm gonna repeat myself again. Price generated a swing high here. The first time, you are waiting to see what price is doing. Second time, third time, and at the fourth time, when price cleared out the third swing high, price rejected, and this is what gives you a strong confluence that price will reverse from this level. Now let's go and see a little bit more, and how will we take our entry and manage our stop loss with this model. So our entry, market entry for the 3 dive patterns occur after the third drive. Okay, this is our third drive, this is our first swing high, this is our second swing high, this is our third swing high, and this is the fourth one that hit the higher time frame period. Okay, we will apply this concept with ICT concept to give us extra confirmation. So in the retail industry, when I was a retail, okay, when price was going above the third drive, they don't know like how far this swing will go. So what ICT did, he made it easy for me to know how far it will go. It will go until there it fills a higher time frame period, or it hits a premium PDR. Okay, this is a bearish, we are looking for a bearish trade here, so this is a premium PDR. Until price hits this premium PDR, you will know the price is gonna reject, and this formation will happen inside our macro. So that also works as another confirmation. In this scenario, again, the same with our previous models. Every single time we have a higher time frame PDR, we apply the anatomy of PDR here, and we manage our stop loss accordingly, the way I taught you guys in the first slide. But if you cannot spot a higher time frame PDR, then your stop loss will be 20 to 25 points. Max you are going is 30 points. So this is where you will enter when price tapping inside the higher time frame PDR, and your target will be what? The first swing low. And here, as you can see, the second swing low is basically got taken out by the third one. So ideal target is 2R anyway, so that's what you will target, and you can see price went even lower. So this folks works like a charm. It's very easy to understand, it's very easy to spot in chart, and it works like a charm. Okay, I'll show you guys a couple of examples and it will make you clear. Here's an example. We have swing high, first swing high, second swing high, third swing high. So once the third swing high clears out, we enter as soon as price is the premium PDR. Or if you cannot spot a higher time frame PDR, you just take your entry here and you manage your trade accordingly. Price will eventually reverse. The target is same. If we can spot a relative equal low, relative equal high, or trend line liquidity, or unfilled fair value gap, that's gonna be your best high probability target. If you don't have it, then I'll highly suggest you not to take it, or target only 2R. Now let's go and look at our second example, which is from the slide. Okay, from this slide, let me take you guys back. from this example. Now let's go and see what price did here. Price generated our first swing high, right? Price was in a bearish trend. Now after that it changed its trend. It generated first swing high, second swing high, the third swing. Why am I not considering this as a swing high? Because this is not a swing high. It don't have a candle right next to it lower. Okay, this candle went above, so this is not a swing high, but rather look here, this candle is higher than this one and this one, so both of these candles are staying lower. So this is our third drive, and as soon as price went above the third drive, what happened? Price hit our higher time frame PDA, right? And when I showed you guys this example, I also applied the anatomy of PDA, right? That is also working as a confirmation here. The anatomy of PDA, we are putting our anatomy of PDA. Our fair value gap was big. We are expecting a rejection from 0.5 and 0.75, right? The midway and the upper quadrant was here, and as you guys can see, this 3 dive pattern is working as a confirmation to make you a little bit more confident to take this turtle soup entry. Isn't it clear? So when you spot this pattern repeats every single time on indices, folks. Okay, even on crypto, I'll show you guys the Bitcoin chart. The weekly Bitcoin chart is repeating there. Every chart that you go, if I go there and see, when price is trending, it's stopping at the third stop hunt, and that's where your turtle soup pattern forms. That's where price gives you a turtle soup entry. So this example was from our second slide. So now let's look at our 3 dive pattern and turtle soup on Bitcoin chart. As you guys can see, we have a chart here. Okay, look here, we have first swing high, right? We have candle lower to this candle, so this candle is lower, this candle is lower. This is our first drive, this is our second drive, this is our third drive, and at the fourth one we expect a rejection. Our target will be what? The third drive low, third swing low, or the second swing low. And as you guys can see, price showed a very beautiful rejection. I already showed you guys how to take entry from this, right? You can basically take entry from here and you put your stop loss like 25 points or 30 points, but the best is you are taking this trade accordingly with your higher time frame PDA. Okay, other time frame, you align other time frames with it, you take it, and it works like a charm. Now look here, the same thing. Okay, the same price action is repeating again. We have our swing high here, the first one, the second one, the third one, and the fourth price rejected. So this is an example from the weekly chart of Bitcoin. I told you guys that this works like a charm on crypto. Most of the time you will see price like exactly to the tick respecting this pattern, this 3 dive pattern. But on indices, what happens is that we see a little bit more volatile price action intraday. So yeah, sometimes you will see that the third dive swing low is getting taken out by the second one. Okay, so this happened, but it also works, and as you guys can see, it's a beautiful formation. Now I'll take you guys back again into the first slide, the first example that I showed you guys, and here also the 3 dive pattern was repeating. When you know the concept, you will see it every single time. Okay, so it was here. Okay, so this is our first drive, right? First swing high right here, then our second swing high, our third swing high, and exactly at the fourth one price hit the higher time frame PDA. So we are basically not taking trades by using the 3 dive pattern alone. We are aligning other confirmation, we are mixing it together, and this 3 dive pattern basically gives me confidence in my trade. So I thought of why not share it with you all, right? It works as an extra confirmation, it gives you guys a confidence, and it's very easy to spot, and it aligns beautifully with higher time frame, right? So first drive, second drive, third drive, and at the fourth drive we expect a reversal. It also aligning with our other logic, right? We expect to see price rejecting from the low of this fair value gap, and after that you guys know what happened. Price rejected beautifully from here after generating the third drive, and after clearing out the liquidity from the third drive, and That's it. So do you guys understand the concept of 3 dive pattern? Let me know in the chat. Is it clear, folks? So there's another. I already shared like 4 entry models with Turtle Soup, right? I shared 1 entry model in day 2, and here I showed you guys a couple others, and the highest probability is relative equal high and relative equal low in our first slide, okay? And other models are like a little bit advanced, so I'll show you guys how to take entries by using these models inside our mentorship when I'm trading in live with you. Until that starts, you can watch my tape reading session on my YouTube channel, and you will see me taking entries by using these models. So 3 dive pattern, folks, it's very beautiful. You will see price, like before price hits a higher time frame PDR, or before price rejects from a fair value gap, it moves towards it, right? When it's moving towards it, it also generating swing high. So when you apply this 3 dive pattern, it works like an extra confirmation. When you see that, okay, price generated three swing highs, now I will wait for price to go above the third one, and this is what will give you a Turtle Soup entry. You will feel a lot more confident when you are seeing chart with this 3 dive pattern. And there's another model that is left, is Breaker and Turtle Soup. So the model is basically like when price is doing the stop hunt in the Breaker model, right? Our Breaker doesn't get generated without a stop hunt. So that's what I'll teach you guys inside my mentorship. And there are 3 other models with Turtle Soup that I'll not show you here. It will be specifically for my students inside my mentorship. So this is it, folks, for the Turtle Soup models. Did you guys found it insightful? Let me know in the chat. And no one, I didn't saw like the other person in ICT community would teach us Turtle Soup is Romeo, right? So did anyone here did Romeo's course? So he didn't talk about any of this stuff, right? He basically like randomly showed you guys chart. I gave you guys a complete model, okay? I gave you guys, okay, if price presents this relative equal high, relative equal low, then you will take an entry. If price is doing this, then you are doing this, like a complete blueprint, a complete structure, a complete model. Okay, so let's now see what will be inside my mentorship. And so this is what I will present to you guys inside my mentorship. So everything about time, price, and all other concepts, right? Basically I shared with you guys 3 concepts. There are two other concepts. There are 2 other entry models that I use, which I will share inside my mentorship. And everything else I'll also share handwritten ICT notes. I shared like 3 or 4 handwritten notes in Twitter, and as you saw, like these are very easy for you guys to understand what basically goes on inside the marketplace. And I'll share like multiple, there will be like more than hundreds of handwritten notes, daily chart analysis and weekly forecast, price analysis, weekly price action breakdown, seasonal tendencies. That's another concept that I'll teach you guys, okay, inside my mentorship. Plus there will be real-time mentoring with live tape reading session. I'll take you guys in the real time in the chart. In other mentorship, no one takes you in the real chart and trades with you, but I'll do that with you. Once we saw the Turtle Soup setup, I'll take it with you in real time. I'll show you guys, okay, this is what is repeating, and that's where you learn the best. I'll do 2-3 times a back testing session in a month, and we will do a whole month, okay? Each time we will do a whole month of back testing and many more. So the booking will start soon. It's not available yet, but very soon I'll launch it, so you guys will know. So the pricing will be for you guys. I'm giving you guys a discount. For you guys, it's only $200 for 6 months. There won't be any monthly charge. You'll basically make the $200 when you see me taking trades in front of you, right? Because look here, real-time mentoring with live tape reading session. So what I'm gonna do, I'm gonna show you that this is a model and this is a high probability model. So what you are doing, you are taking it with me, you are making money. So basically $200 investment is nothing. There won't be a monthly fee for 6 months. Even there's a discount, like other people who are not inside my mentorship, right, this 3-day workshop, they will be paying $250, but for you guys it's only $200 for 6 months. And trust me, you will make way more money, plus you'll gain way more experience when you are trading live with me, when you are learning from me, when I'm showing you live in this chart that this is what happening, and that's what you should do, and that's where the best growth happens. Okay, when you saw my tape reading session on YouTube for free, go back, if you didn't, go back and watch the last session. See how much you improved just by watching one live session. And I'm gonna do it with you every week, 2 times for 6 months. Man, that's the best offer. So the mentorship is not available yet. It will open soon. I will yet to build the website, which will be hydramentorship.com. So when I do it, the booking will start from I think from December or at the midway of November. So I'll let you guys know. For you guys, this is a discount, $200 USD for 6 months. And for the other people who are outside, they will pay like $250. So there's a $50 discount, and trust me, you will make it back in like 2-3 days. So don't worry about that. So this is it, folks. This is the complete of our 3-day bootcamp. I will do a back testing session to show you guys how I will do it inside my mentorship, so that you guys know what you are paying for, right? So the back testing session will be on 10th of November. I'll share the timing with you all, okay? And this will be free. You guys don't have to pay for the backtesting session. I'll take you guys in the FX replay. I'll use FX replay, and we will use a whole month. We'll backtest a whole month inside our macros, and that session will be like 5 or 6 hour longs, right? So already what I shared with you guys here is more than, like, I believe our first lecture was 5 hours, right? Second lecture was 3 hours, and this lecture was 1 hour 30 minutes. So 11 hours of content, no trash talk, all knowledge. Even this is on discount, $80, and you are getting this. I saw like another day Twitter influencer, he is like 10 hours of content and he's asking for $200. That's it. There's no other thing. It's just a theory, and people are buying it. So you saw what I can present to you with the quality of content. You saw me live trading. You saw me tape reading. So I hope to see you guys there in the Hydra mentorship. And this is gonna be it, guys. This session is recorded, so you'll be able to access it again. And that's it, folks. I hope to see you guys in my mentorship, and also in the 10th of November. Don't miss it, okay? That session is not going to be recorded. I'm not going to record it. I'm sorry to let you guys know that the backtesting session is not going to be recorded, so you will have to be there. So the time that I'll decide it with you all, okay? It will be based on like most of the people that prefer. We will not record backtesting session because that's where the real mentoring happens. I don't care like if someone leaks my content, because you cannot become profitable just by using theory. You need someone to show you how it works in the live price action, okay? When you're figuring out it by yourself, it takes a long time. But when you are learning from someone who can do it in live market, your experience, your learning curve, folks, trust me, it gets slower, okay? You learn very first, and you make money first, right? You make money That's it, folks. That's gonna be it for today. And if you guys have any question, our Telegram group will still be open, so you guys can ask me question there, and I'll try to get back to you as soon as possible. So that's it, folks. Peace.